There's something very powerful about starting with a clean slate with no presumptions. And in that spirit, let's ask ourselves, what, in its essence, is accounting? And the suggestion is that it is just a way of organizing financial information for decision-making purposes. So let's explore that concept of organization itself. Look at the shapes in front of you and organize them into groups, thinking about the logic of what you're doing. You may have noticed a few things. There are different ways to sort the shapes. You can sort them by shape, and you can sort them by color. You can sort them by size, and you can have more groups or less groups. Without further instructions, there's no right way or wrong way to organize the shapes. You can organize them in a way that works for you. You can choose the basis of classification, such as color, shape, or size. And you know the personal benefit that organizing will bring. You may be able to count them more easily, establish what's missing, or come up with new shapes. Where we're going with all of this is to draw an analogy with accounting. Accounting is simply a way of organizing financial information instead of shapes. And just like the shapes exercise, there are benefits to having the financial information organized and different ways of doing so. You see, people think of accounting as an exact science, probably because they've heard that trial balances and balance sheets must perfectly balance. But actually, there's a lot of possible alternative and different ways of organizing financial information. When setting up an accounting system for a company, you can have lots of accounts or fewer accounts. You could have a separate account for each different type of travel expense, such as airfares, train tickets, taxis, and hotels. Or you could have one broad account for all travel expenses together, for example. How you set up the accounts depends on what you want to use the accounting information for. Your decision-making needs will determine how much detail you need. The process of setting up which accounts you will use, for example in an accounting program like QuickBooks, is called designing the chart of accounts. What you want to call each account is up to you, although there are many traditional names used. However, having just made the point that there is lots of choice within accounting and no single right way of describing things, there are some things that we all need to do the same way. In accounting, there are 5 basic categories of accounts, and we can't mix these up. The 5 basic categories are assets, liabilities and equity, expenses and income. Each is an absolute concept and cannot be interchanged. You can switch travel and marketing expenses, but you can never switch assets with liabilities. Just like you can't turn an apple into an orange, they are fundamentally different concepts. Color accounting uses a diagram that would in computer terms be known as a graphical user interface to show how accounting works visually. When you understand the workings of the diagram, you by and large understand accounting. We call the diagram the color accounting framework, and it will soon be your best friend. It's also known as the basis framework for the balance sheet, income statement, reports that it comprises. Getting perfectly clear on the 5 fundamental elements is one of the most important learning outcomes you will gain from this course. So let's now begin to devise an organizing system that we can use to tell the story of any business. Business is all about assets because it uses them to generate income. And generating income is why businesses exist. Let's think about the nature of these assets. You may be noticing what we call fixed assets or non-current assets that will last for a long time, such as the computer and building. And there's the inventory for sale that will disappear much sooner, and which we therefore call a current asset. And there's the cash, which is the most liquid asset because it's the most spendable. You may be thinking about people or the reputation of a business, both of which surely help it earn income. In a very broad sense, they too are assets of a business. And for that reason, many a human resources manager can be heard to exclaim that people are our greatest asset. However, as accountants, we use a narrower definition and do not consider people and the reputation of a business to be assets. Accountants exclude them because of what we call recognition criteria. To be counted or recognized as an asset for accounting purposes, the item in question must have been acquired and the value measurable. Since people can't be owned, and since the value of a reputation is too hard to measure precisely, as accountants we don't count them as assets. Think about the types of assets your own business uses to achieve its goals and mission, or assets that you yourself use, for example, to get to work, like a bicycle or car. Some businesses are asset intensive, requiring huge factories to achieve their purpose, and others are less asset intensive, such as a business consultancy, where services are provided using employees' intellect rather than machines and equipment. While we're comparing assets and their role in business, we can ask ourselves, why do businesses tie up so much money in assets? The only reason that businesses have assets is to generate income, which is to say, generate more assets. Businesses use assets to generate further assets. Continuing with our Socratic question-led approach, we now ask ourselves, how does a business fund these all-important assets? Let's investigate further. You'll see that a new facet has peeled off from our assets, opening up to form a butterfly. The right-hand side of the butterfly will represent the sources of funding to acquire the assets that are represented on the left-hand side. We'll give the right-hand side a heading, Sources of Funds, and let's color it yellow to further distinguish it from the left-hand side. And we should give the left-hand side a heading too. If the whole butterfly is describing a funding story, and the right-hand side represents the sources of funds, what heading should we use for the left-hand side? We'll call it Uses of Funds, and let's color the left side green. It's important to remember whose funding story the butterfly is describing. So let's give the story a name. In this case, Global Retail Incorporated. Inherently in trade, there are multiple parties to a transaction, and lots of confusion in financial conversations happens because people forget whose story is being told. Now, drilling deeper into the sources of funds, we ask ourselves, what are the possible specific sources of funds to set up the business with? Where could the business get funding from to acquire assets so that it can start operating? There are two basic sources of funds for starting a business. Firstly, the business can borrow from a lender, incurring an obligation to repay the funds to the lender. So let's reserve the top half of the yellow side of the butterfly for what we call liabilities. Secondly, the business can obtain funding from the owners of the business. The owners invest the money as owner's capital or owner's equity. Note that businesses can also borrow money from the owners like it does from other lenders. But in this case, the money is invested rather than lent. The business doesn't have to pay back owner's equity in the same way as it has to repay borrowed funds. The difference between debt and equity is not so much who it comes from, but the terms under which the funding is contributed. Liabilities incur interest, whereas equity pays dividends. Liabilities must be repaid, whereas equity doesn't have to be. Liabilities don't come with votes to control the company, whereas equity does. And if the company is wound up, the lenders must be paid first because they have what is called a priority claim that ranks ahead of the owner's claim, etc. There are exceptions and gray areas to these rules, but broadly, these are some of the ways that debt differs from equity. To be clear, liabilities and equity are not money and are never tangible. They are quantified in monetary terms, but they are not themselves money. Money is an asset, so is always on the green side as a use of funds. Liabilities and equity are intangible legal concepts representing two forms of claim on the assets of the business. You can never touch a claim. Liabilities and equity represent where funding for the assets came from and to whom the funding would return. Let's now put in some amounts to show a funding scenario. Let's say a lender lends $30,000 of cash and the owners invest $20,000 of cash. Clearly, then the business has $50,000 of assets sitting as cash in the bank. What we immediately see is that the sources of funds are equal to the uses of funds. The liabilities and equity amount to $50,000 and the assets do too. So to rephrase this, assets of $50,000 equals liabilities of $30,000 plus equity of $20,000. And what we have just distinguished by doing this is what we call the accounting equation. Let's write this equation out in a more traditional format. Assets equals liabilities plus equity. People often misunderstand what equations are saying. This equation is not saying that the green side is the same as the yellow side in all respects. It is only saying that there is a certain equivalence of amount of the green side and the yellow side. The nature of each side is quite different. The nature of one side of the accounting equation is sources of funds. The nature of the other side is uses of funds. The nature of one side is assets. The nature of the other side is claims upon the assets. In quantity terms, both sides amount to $50,000, but that's where the equivalence ends. You may have realized by now that what we have represented as a butterfly is also a balance sheet. The balance sheet is the all-important picture that describes the position of a business, what assets the business has, and who has claims upon those assets, being either lenders or owners. One of the last points we made in the previous conversation was that the butterfly is an alternative presentation of the accounting report known as the balance sheet. We will now continue to use this balance sheet in the slightly modified form of a framework to tell the story of a simplified business. You can now see the butterfly morphing into the three boxes of the framework entitled Assets, Liabilities, and Equity. As before, let's make sure the diagram reflects the name of the business so that we lock down the point of view of the storyteller. We'll continue to call it Global Retail Incorporated. We'll use the framework to capture a series of transactions all seen from the point of view of global retail. Let's imagine we're starting a business and of course we need some money to start operating. Let's say the first thing the business does is borrow $30,000 from a lender. This is repeating what we saw in the butterfly, but we're going to put more emphasis on the specific transactions this time. Stop for a moment and see yourself inside the imaginary business and the loan funds, the physical cash coming in. Our job is to describe the effects of this transaction on the framework, which is currently blank. Now, ask yourself, which of the three boxes will be impacted and how? The first impact that many people describe is the increase in liabilities from the initial 0 to $30,000. you can see that the loan account in the liabilities section of the framework has increased by $30,000 to $30,000. This correctly represents the fact that after the transaction, the business has a liability to the lender of this amount. Sometimes learners stop there and think that the recording of the transaction is complete, but it's not. What hasn't been accounted for yet is the cash received. The liability section never describes cash. The nature of cash is never a liability. Cash is always an asset, and therefore we must also show the asset section increasing by $30,000 from 0 to a total of $30,000. So now you see in the asset section the cash account increasing by that amount. What you've just done then is your first journal entry. The journal entry always has two effects that impact the framework, or in traditional accounting terms, what is referred to as the general ledger. You can see that the framework is in balance because the asset side equals the liabilities and equity side. The sources of funds are equivalent to the uses of funds. You've also discovered the principle of double entry. This is the rule that every transaction has not one, but two effects upon the balance sheet, and this cleverly keeps it in balance. Hence the term double entry accounting, or double. Let's say the owner now contributes $20,000 from his or her savings account into the business bank account as an investment, not a loan. Think about where this transaction will impact on the framework: assets, liabilities, or equity. There clearly has been a new source of funds to the business, although this time it's not in the form of a liability. So we see the owner's contribution account in the equity section increasing by $20,000, and the same cash accounts in assets as we used previously increasing by $20,000 also. So now the balance sheet reads $50,000 of assets, which are funded by $30,000 of debt and $20,000 of equity. You'll see an option to see the same information that is shown in the color accounting framework laid out in a traditional balance sheet view. It's telling the same story, just laid out vertically and without color. The business at this moment in time has $50,000 of assets, and they were funded by $30,000 of debt and $20,000 of equity. The story evolves, and the business now provides some consulting services to a client at the client's premises, and they pay $700 in cash. Our job is to describe the effect upon the balance sheet of this transaction: assets, liabilities, and/or equity. The cash part of the transaction is easy. We've increased our assets by $700 by placing $700 into the business bank account. So what's missing here? We haven't described who has a right to the $700 on the sources of funds side of the balance sheet. Has the business incurred a liability because of this transaction? The answer is no. The amount we owe the lender hasn't changed. It is the owner's claim against the assets that has grown: equity. The liabilities and equity sections represent both a source of funding, which is to say where funding comes from, and they also represent claims upon the assets of the business by the respective parties, being the lenders and the owners. The lender lent the business $30,000 and therefore has a claim upon the assets of the business of $30,000. The owners of the business put in $20,000 and therefore claim that back. And they also claim any additional value of assets that are generated through earnings. So the second $700 goes to increase the equity section. And for the moment, let's call the account to be increased profit. It's a hugely important account because the reason for the for-profit business's existence is to generate a profit. For that reason, Let's highlight the account with purple, P for purple and P for profit. Now the balance sheet is in balance with $50,700 worth of assets, $30,000 of liabilities, and $20,700 worth of equity. There are now two subtypes of equity. $20,000 is what we call contributed equity, and $700 is earned equity or profit. Now let's imagine that the business incurs an expense of $300 in order to earn the $700 of income. Perhaps it's hired a limousine service to get to the client and paid the driver cash. So our assets have decreased by $300, being the reduction of the cash in the business bank account. And the profit account in equity will also decrease by $300 down to a balance of $400, because profit is calculated as income less expenses. In this case, 700 minus 300, giving us a final profit of $400. On the use of funds side, the total assets decreased, and on the sources of funds side, so did the owner's claim on those assets. The balance sheet is still in balance with $50,400 of assets, $30,000 of debt, and $20,400 of equity. Take a second to think about what we've done. We've described a picture of where the business is at, but we have a small problem. We've lost part of the story about how we got there. The balance sheet is giving a true snapshot of the financial position of the business, but we've lost some useful information along the way. If a friend came along and asked, how did we earn the profit of $400? We wouldn't be able to tell them by looking at the balance of the profit account. By netting off the $300 from the $700 to show the net $400, we've lost some useful information about how we performed along the way. For example, the business could have earned the $400 by making sales of 1,000 with expenses of 600, or by making sales of 401 with just $1 of expenses, or any other number of combinations that net to 400. What we've lost is the margin information. How much profit the business makes in proportion to the sales that it makes is a very useful piece of information to know. $400 of profit from sales of 401 is a much higher margin and usually more desirable than a $400 profit from sales of $1,000. In the scenario we've described, the profit margin was somewhere in between these, being $400 of profit from $700 of sales, a profit margin of about 60%. Where this is all leading is that we need a place to tell a more detailed story of the profit. Let's call it the profit story. In more traditional terms, it's called the income statement, the profit and loss statement, or the P&L, or also the statement of financial performance or statement of activities. We're going to invoke a computer analogy here, specifically the double-click function. If you think of your own computer, when you double-click a folder, what happens? The folder opens up and reveals the subfolders and all the detail inside the top folder. You can see this explosion of the profit account to form the profit story happening in front of you. You'll see there is now a new yellow sources of funds box and a green uses of funds box. Your task is to decide which of these new boxes will be income and which will be expenses. Start with income. Will it be on the yellow side or the green side? Income represents a source of funds to the business, so it needs to be on the yellow side of the color accounting framework. And we can clearly see that businesses have three sources of funds. The funds can be borrowed by incurring liabilities, invested as equity, or earned in the form of income. Having income on the yellow side often surprises people who instinctively want to see income on the green side underneath assets. The instinct may come from a sense that the green side is the good side and income is good, therefore income must be green. But it is wrong to think of the green side as the good side. The green side is the uses of funds side and includes expenses, which you could think of as bad inasmuch as they represent a loss of value. As we have just one box left to choose from, the green box at the lower left on the uses of funds side of the framework, that must be our expenses box. It is, and it makes sense when we realize that a business can use the funds it has sourced to either acquire assets or to consume as expenses. Expenses are a use of funds and are therefore on the green side. The color accounting framework now has its 5 elements, which we refer to as boxes: assets, liabilities, equity, income, and expenses. And you can see why it's also called the basis framework, because it combines the balance sheet with the income statement. Now, let's redo the $700 and $300 transactions using these new income and expense sections. When the business makes a sale transaction of $700, how would we now record it using the 5-box framework? The 700 cash effect will still be recorded in the asset section, business bank account. And now, instead of recording the other $700 effect in profit directly, we are going to put it in the income section, giving it an account name called, for example, consulting. And we show this income section increasing by the 700 that we have earned, we being the company, of course. And notice that the profit account in the equity section still increases by 700. It just does so indirectly. This is because whenever there is any impact in either the income or expense sections, the effect is reflected in the profit account. The bottom 2 boxes are connected to the profit account with the vertical connector we informally call the umbilical connection. This is the color accounting way of representing the double-click connection between the balance sheet and the income statement. To record the $300 expense transaction, we show the decrease in cash of $300 as we did before, but we'll record the second $300 transaction effect differently. Again, instead of going directly to profit, we'll go indirectly via the income statement. Ask yourself, would you expect expenses to increase or decrease? Some people are tempted to say decrease, but this is to confuse cash and expenses. We have less cash but more expenses. People often incorrectly think of cash when they are contemplating an expense. We have more expenses, so expenses increases by 300. Notice how the profit account in the equity section has now decreased to $400 because the profit is calculated as income less expenses. So again, the 700 minus the 300, giving the $400 profit. To summarize then, we now know that the top 3 boxes of the color accounting framework represent the balance sheet, and the bottom 2 boxes represent the income statement. We know that the income statement connects to the balance sheet by way of the profit account in the equity section.